Umbrage. This was the latest word to catch fire in Singapore. One question from a lowly journalist sparked a burst of fire in the CEO of SPH, who then began his rebuttal with this word, umbrage. While umbrage started trending, so did another important piece of news coming out from the conference. It's that Singapore Press Holdings is going to separate off its press holdings part into a not-for-profit or CLG, Company Limited by Guarantee. Is this demerger going to be good for SPH stocks in the future? Is this move actually going to allow the company to grow? Let's find out. Hey investors, it's me, Ali, your humble graduate from Value Investing Academy and most un-umbrage-taking individual in the investing YouTube world. Today, I talk to you about Singapore Press Holdings or SPH. We look at its current history, we discuss what is in the business mix right now, we talk about the changes in leadership over time and what's in store for the future. Before I go on, I hope you find this topic interesting. Show me how interested you are by hitting that like button and that subscribe button. Let's talk about the birth of SPH. Once upon a time, in 1984, there was the birth of a company, Singapore Press Holdings. It came on the backs of major newspapers already existing in Singapore. Times Publishing Berhad, the Straits Times Press Limited, Singapore News and Publications Limited and Singapore Newspaper Services Private Limited. The idea was to cut down on wasteful competition amongst the newsmongers of Singapore. Over time, new business models were spun out to tantalize the reader buds of Singaporean eyes. They did so by publishing books and hawking magazines such as Her World and Men's Health. SPH also acquired a 20% stake in MediaCorp TV Holdings Private Limited. Since those historical times to now, the business model has been simple. Sell media. And for some time, they were doing it quite well. But the papers stopped flying off the shelves and this was of concern. In a country like Singapore, where the press and media are strictly in control of the government, it is a surprise that even with a strong and natural economic moat, I'm talking about licenses of course, that SPH failed at turning in a profit for the past few years. Now, I know some of you might be saying, bro, you know how tight regulations are on them in Singapore or not? You know how carefully their actions are weighed by the big brother? How to make money like that? But I don't buy this argument for even 1 second. SPH is a public listed company. They sold shares of their equity and are bound by the unwritten promise to deliver valuable and tangible results to their stockholders. So whatever the situation may be, SPH's board and management should be delivering profits. And since profits and money is the concern, let's start by reading the fine print of the financial report. I'll start by looking at the past 10 years of SPH. Let's start with revenue. Oh my god, such a smooth line, but going downwards. Frankly speaking, I would have jumped ship 5 years ago. And in 2020, we can finally see that the earnings have dipped below the horizon to finally give its first negative showing. In 2020, SPH reported an EPS of negative 0.07 cents. Free cash flow has also been bleeding red since 2013, when it was negative 234 million. SPH, however, did bounce back a little bit, but then it clocked another 4 years of negative free cash flow from 2016 to 2019. Now, for entertainment and information purposes, I'm going to put on my thinking hat and ponder on some points. Firstly, it's that revenue and profit has been in decline because less media is being sold. So, as management, maybe I should cut down costs. Now think, as a media company, what is my major costs and can I cut it? What costs can SPH not bear to pay? Unlike factories that produce goods or tech companies that rely on selling handphones, this media powerhouse depends on its writers, its staff. It can print one newspaper or print 1 million newspapers, but it still has to pay its staff to create the content in that newspaper all the same. So let's look at the cost of staff of SPH over the past 5 years. Staff costs listed in their income statement shows that it has consistently remained above 300 million. Also, where it was 362 million in 2016, staff cost has only dropped to 330 million. So where revenue has dropped by 300 million, staff cost has only dropped by 20-ish million. So here we may see one reason why SPH has finally bit the bullet and decided to cut away a large cost from its belly. Now let's look at SPH in 2020. I'll start off by talking about management. Say what you want about the history of the CEO. You cannot dismiss that the other board members and chairmen do have some experience, clout and foresight that is world-class. No doubt there is an invisible hand in play. Say what you might, it's difficult to assess and even more to quantify. That said, let's dissect the performance of the current business. With the media arm cut, what do we have left? Well, mostly it's just properties now. There is a student's hostel, an old folks home and a condominium, and of course a retail property parked under SPH REIT. But, and this was quite surprising to me, everything except media is actually doing well. From the 2020 annual report, we can see that under assets of the balance sheet, investment properties has grown from 4 billion to 6 billion in 5 years. Likewise, cash has also grown from 320 million to 860 million. If we look at the profit margin generated by these property investments, we can see that it has been growing and has been in the positive except for the COVID-19 period. So it's actually making SPH some money. My biggest fear when looking at SPH is the risk that it has spread out the purchases of property quite thin globally. It's got property and business holdings from UK to Japan to Australia and of course REITs in Singapore. Investment requires oversight and property requires maintenance. I'm not sure if it's prudent diversification or disastrous diversification. What we cannot deny is that media has been killing this public listed company while property has actually been its saving grace. Now let's conclude. What is my take on the umbrage saga? Firstly, it's shocking. It's unfair to its nature and its staff. SPH was a media giant in Singapore, and with all of its economic moat, you cannot blame the internet into eating into its revenue stream. The consensus amongst my friends and many online is that the standard of media has been dropping for the past decade. Secondly, it's not a completely illogical thing to do. I'm talking about the CLG, of course. The media business was dying, and instead of sucking dry the parent company of money, it may be wise to cut out the cancer. Third, what I do not like, if I was a stockholder, is that I would be unhappy with the fact that almost $300 million worth of assets, real or intangible, of the company is being given away. While media was losing money, it's still some assets, tangible or not, that could have been sold off, but it's just given away. Lastly, I have no qualms about the CEO directly. I think the management as a whole is qualified to run the current business. However, the invisible hand is what I cannot quantify, and that leaves some room for residual risk that we just have to live with. So, I hope you like this video. I hope many of you do not take offense to what I said. If you agree with me or disagree, please do share your reasons why. Write your comments below and don't forget to hit that like button and that subscribe button. See you next time.